You drop any more, and we're going to trigger the banks. Now, that's where I think the Fed will do an emergency rate cut. And that is not good for the stock market. If you go back to the 2000 top or the 2007 top, when the Fed started cutting rates, that was a sign they knew something was wrong. So I think we're at that cusp right now.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for August 5th through August 12th, 2024, while supplies last. First, we feature 2024 1-ounce silver American Eagles at $5.50 over spot. Next, we have backdated 1-ounce silver Austrian Philharmonics at just $3.10 over spot. We also have Dealer's Choice Constitutional Silver half dollars at $2.50 over spot per ounce. Next, backdated 1-ounce gold American Buffalo are just $99 over spot. And finally, we have a limited quantity of 1-ounce silver full-color Trump Fight for America bars, just $6 over spot. They come 20 to a sheet, and so have a minimum order of 20 and are sold in multiples of 20. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you today. We've obviously had an interesting week in the markets here, and there's calls for the Fed to have an emergency rate hike. Your perspective on what is happening in the economy and the markets, it seems like everything is selling off right now. And what do you think the Fed's response will be?
Well, there's a lot of economists out there who are mainstream pro-Fed type economists, who have said too high, too long. And even the Fed has stressed since early last month, even Powell gave a press conference where he stressed that staying too high, too long could do damage, even without waiting for the data to prove that it did damage, that it could do damage. And yet he hasn't cut. What's he trying to do? Play a game? And a lot of people are wondering, why not? The job data has not looked good. And not only not looked good recently, but even when you look back at the prior job reports months ago, they were getting worse and worse in terms of, long-term jobs, not the short-term, et cetera. And they've ignored that. And now this Japanese event hit where Nikkei crashed. We have a yen crisis. The yen has rebounded, but it's caused a problem with the yen carry trade thing where a lot of people had positions based on, all that stuff. And a lot of that's unwound, no doubt, recently, due to the recent sharp drop in the stock market and the panic. And I suspect this week we're going to hover around in the stock market and cool things off for a few days. Next week, probably resume. There is one variable out there that I know will kick the Fed in the gut, and that's the banks. We went through this back in January of 2023, the KBE, which is what we watch, the primary one, it's the ETF of the larger banks. January 2023 late, we warned there looked like a crash situation setting up for the banks. Technically speaking, we had no knowledge of any specific banks, And then the stories came out about regional banks and all that, but they did crash. And in fact, in early March, they hit our trigger number. And within about 5 or 6 weeks, they dropped 34%. Now, that's a crash dimension, that percent. It was a little slower than a crash, but still, it was a crash-like drop. The Fed didn't cut them because they were already in the process of raising rates, so they couldn't abruptly stop. But they've now said, okay, we're through raising rates, and they're looking for a reason to cut. And I'm telling you right now that momentum analysis of the KBE is almost precisely the way it looked prior to that March debacle, March, April, May of last year. The problem now is the market can't take it. The broad stock market. Back then, the stock market had already had a major decline in 2022 and was trying to turn up. So when the banks had that drop in March, April, May of last year, it caused the S&P to pull back a little bit. It didn't make a new low, but it was already had been punished. The S&P had. This time around, the S&P has only just now become vulnerable. And so if you kick the KBE through its structures, and they're literally a few percent below the low we saw this week, if you trade those levels, like we traded down to 47 on that ETF, you get down to 46 or much lower, and it's going to start. And I argue that if that starts, it looks like a something that could be fairly rapid, headline-y type stuff. That is a sector of the stock market the Fed will not dismiss. I don't think they care about NVIDIA, but they care about those banks. And if you look at what happened last week on a percentage basis to that ETF and also to the major name banks, the percentage drop they suffered last week and are not really recouping from this week was far more than the S&P suffered. And yet that wasn't a headline. You drop any more and we're going to trigger the banks. Now that's where I think the Fed will do an emergency rate cut. And that is not good for the stock market. If you go back to the 2000 top or the 2007 top, when the Fed started cutting rates, that was a sign they knew something was wrong. So I think we're at that cusp right now.
So you actually do see a strong possibility of the Fed cutting rates before their September meeting?
Yeah, I definitely. The key is the bank index, the bank sector. And we think technically is very vulnerable to something dramatic. And I don't think it's going to be delayed too long. Why? Because the banks had a huge up month last month. And when you look at the price charts, it impressed a lot of people. Now, they didn't go back to their 2022 highs like the S&P and other indexes were, but they shot up, halfway back up there. They looked really good in July. They erased that entirely in the first days of August. The entire big, huge up month was gone. And so it's moving pretty quickly. And the structures we see were approached so closely. And when I say structures or momentum, I mean, if it were a price chart and you saw what we see on momentum, you'd say, oops, this is going to break down. Okay. We came to suddenly right to those levels. And you may pause for the rest of this week. That's fine. There's justification for that, technical justification. But it looks like it was intent to come down and break those structures. And if you do, I think you'll see precipitous further price decline in the banks. This time one that the Fed will respond to, unlike back in March of last year. And I think they'll have an argument to do so. And it won't be, something going on in Japan and the Japanese carry trade and all that stuff. This will be domestic. So it's something to watch. Now, by the way, I'm going to mention this because the silver and gold investors are rattled right now, especially silver investors. We'll get on that in a minute. But basically, it's our argument that the monetary metals are in opposite sync now to the stock market. Yes, recently they've pulled back, but they've already been pulling back basically in momentum terms since April, May. So it's been several months of congestion for gold and silver and pullback in silver. Meanwhile, stock market only peaked last month. While they were pulling back and pausing, stock market made its high in July. It has broken enough stuff in the stock market to indicate that asset category is now shifted to a negative long-term status, which is opposite to the major trends of gold and silver. They tend to be opposite. So if you look back and say, well, if the banks are going to crash again, wouldn't silver and gold crash? Well, go back and look at what happened in March through May of last year when the banks dropped 34%. I'd see where are my numbers here. Gold was jumped to $250 in the same time period, and silver went up $7. So it was totally beneficial to them. So I tend to expect that same response this time around in the monetary metals once the banks are triggered. So it's something to watch, especially starting next week.
Now, with respect to precious metals here, you shared with me a few charts I'd like to share. And this is back in 2010 and 2011, where we saw a huge increase in silver in 2010, but then we did see a pullback, and then about $28 to almost $50 was just a few months there. So do you see a similar thing could happen now in the silver market?
We argued back in late March, based on annual momentum of silver, gold, and the gold miners at price levels that are below where we are now. Okay. That the zone of congestion that we'd been in since 2020, where we'd gone up and down in gold, but basically sideways, and silver had descended in a channel, and so had the gold miners. That was over with. We're resuming the bull market that actually began in late 2015 for gold and related markets. Yes, it had a 3-year pause. That happens in major bull markets. Even this one you're looking at now, we're looking at the final 3/4 of a year of the bull market that already began in 2000 from lows in the year 2000. And so we're looking at what I call the acceleration phase at the end of a already protracted bull market. Again, our bull market, we argue, is underway since late 2015. Gold was 1,050 at that time. And we think we've entered the final several quarters of the we call the acceleration phase. Now, this is the silver price action back during that time. Back in August of 2010 and September, as silver moved up toward $20, we broke out enough long-term momentum metrics to argue that the acceleration phase was commencing. And sure enough, you had a nice move. I mean, silver went from like $17, $18 up over 30. Similar prices we have now. And then you'll notice the little red lines I've plotted under these pivotal lows on price. So if you're a price chartist, you see this ascending pattern. Well, obviously, when you broke that last red horizontal, you said, oh my gosh, we're in negative zigzag. And so no doubt a lot of people were stopped out and the market got washed out. It dropped from like $32 down to about 26. Okay. And spent a couple of weeks down there spinning underneath that last point of breakage. I've circled that level, but it looked negative. If you looked at the price chart, that is. But that was a cleansing. It was the cleansing prior to the real vertical portion of the move, which was just a matter of about 3.5 months from late January of 2011 through mid-April of 2011. Silver went from $26 to $50. Boom. But before it happened, it did have that cleansing break. So we suggest that we think we're in that similar situation right now with silver.
How soon, in your view, do you think we could see $50 silver?
Well, I think the bank sector is something to watch, because if that happens, obviously, some people will think, gosh, the metals will go down because, the market's going down. Go back to March to May of last year and the crash in banks. They went vertical. Okay. I think that next snap we get in the stock market, led by the banks probably, that's when the gold and silver will wake up, because they are monetary metals, okay? And they respond to central bank panics, monetary flows, artificially lower rates, et cetera. That's the fuel behind the monetary metals. And I think at that point, probably sooner, we'll start to see both of the metals firm back up. Now, remember gold, well, flip to the current charts, if you will. We'll take a look at that. But look at the gold and silver below it. This is weekly action. Now, what we do here is on that chart, both charts, we circled the September low in 2022. Now, if you recall, back then in gold, it had dropped from over 2,000. And finally there you go. In late 2022, you had this washout that carried down close to 1,600. Everybody thought it was all over, going to big bear market. And we argued, no, it was a bear trap. Silver at that point in time was down to just above 17 at its low. And looked like heck. Okay. And then we surged up out of that low and leveled off in early 2023. In fact, you'll see that spike in silver starting in March. It was about $20. It shot up over 19 something, shot up over 26. That was the time of that bank collapse I talked about. Now go up to the gold chart above. You'll see how it did. It also shot up during that period, during the bank event. And then it went sideways, but firm until early this year. Now there was the surge, the acceleration phase measured by annual momentum again. We argued occurred in March. And you'll see the gold here. In fact, in price, you could see it as well. It shot up over 2,100 and bolted by April. You made a peak close in the above 2,400. That's where the little horizontal red arrow commences at that peak close in April. At that point onward, both metals went into a congestion type process where they were both up and down. In gold's case, it's more or less lateral. If you scroll down to the silver chart, you'll see that its peak in April, peak weekly close that is, was vastly surpassed in May. While gold basically stayed contained below its May peak, silver shot well above it. Silver is what we call a wild dog. And if you're in silver, you have to realize it's a wild dog. In other words, it's got a leash and it's attached to gold, but it's both much stronger than and often seemingly much weaker than. And of course, it was much stronger in that May surge where silver went 10% higher than it had been in April, whereas gold basically stalled at its April high. Now, you can see that the current action, this is through this week, down under 27 even, is below where the April peak weekly close was. We lived above it for a while. Now we're below it. Okay. Now scroll up to the gold chart and you'll see that it's basically at it. So gold's really more sleepy, but it's steady. Now, by the way, last week's close on gold, that was the new high weekly close. And right now, trading where we are at the moment, we're down about 3% below the peak weekly close of history. And yet people think, oh, gold and silver collapsing. Okay, silver is seemingly. Gold is yawning, okay, despite the stock market debacle. But I've circled the low in 2022 and the recent high in gold. And I've also done the same on silver. And I want to read you a number. Though silver looks weak, okay? But from that low to the high, gold went up 54%, silver went up 89%. And even at the current level where gold is right now, as we do this interview, it's up 49% from that low back in September, where silver's up 56%. Yes, silver is a wild dog, but that's the way it behaves. Now, we argue that if you flip up out of here again, and I think we will, silver will be the wild dog on the other end of the leash, pulling gold up. It will be far stronger than gold. Right now, it's weaker than gold over the last month, especially. But that's the way silver behaves, unfortunately or fortunately.
Well, it definitely will be exciting to see what happens in the coming months here. I did want to ask you, obviously, we do have the election coming up. How do you see that impacting the markets, whichever way it goes? Because it seems like, most forecasters are saying that it's a toss-up right now.
Yeah, well, let's I'm not going to express an opinion on either side, okay? But my assessment is this: that is a factor that is not in the markets. Everybody knows that the country is divided, et cetera, and it's maybe different this time, but nobody senses that there's no outcome to this election, no matter which side wins, that's going to be copacetic. In other words, it's going to be uncopacetic. Now, I'm going to give you a hint. Now, this is not me talking. This is University of Virginia. I may have read these before on one of your interviews, but I want to do it again. Back in October of last year, they had a poll at the University of Virginia Center for Politics. They polled both Biden support Democrats and Republicans, likely Trump supporters. They asked some very interesting questions. And here's one of them, and I'm quoting them directly. Roughly half, 52% of Biden voters and 47% of Trump voters, again, this is like 9-10 months ago, viewed that those who supported the other party were threats to the American way of life. Huge percent. About 40% of both groups, 41% of the Biden, 38% of the Trump voters, at least somewhat believe that the other side had become so extreme that it is acceptable to use violence to prevent them from achieving their goals. Okay, now if you think things have cooled down since then, we know that isn't true. And I suspect, therefore, if the University of Virginia did this poll again, they'd find the numbers are even higher. Propensity toward acceptability of violence. Well, again, is this priced into the stock market's view of future reality? Are we about to see 54 card pickup? The tablecloth yanked off the table, everything shattered. And we don't quite know what's on the other side, but it isn't orderly. Is that priced into the market? I don't think so. It's just something to ponder on. Again, that's the numbers from University of Virginia Department of Politics poll.
Now, is there, I guess, precedent for that where societal unrest or political unrest translates to negative outcomes for the economy? Or just sentiment in the stock market. Remember that's moved a lot by sentiment, not just so much data points, but I'm sure data points would be affected. I mean, if you're running a company and you have one
economic data points that are coming down, and you're not an economist, but you run your company, and you're either going to hire new workers or lay some off or not hire anymore or cut your production capability or not build a new factory, et cetera. All these variables outside that we're talking about, like, political uncertainty, data points that are getting worse, will cause you to have an economic consequence down the road if these things started to happen. So yeah, it could be. But I think the main thing is the emotional impact on voters who, when they're in the stock market, you don't want to have some dark cloud out there that is uncertain in terms of its wave effects. What do you want to do? Well, you want to stay speculatively long, or do you want to lighten up your portfolio and go to cash or go to bullion? And this is a variable, I think, that would assist the monetary metals again, because as you enter a period of uncertainty, this is also a factor that would impact the Fed decision. Oh no, they don't talk about politics. They swear that's true. Okay, but uncertainty caused by politics and its impact on economic data points, they'll be fully aware of that. And so if the Fed starts panicking because the bank sector starts to break in the next week or so, that's just the beginning. Sentiment can go from light to dark overnight. And suddenly, if you have a fear factor, what are you going to buy? And I suggest to people that they stand back and, silver's weaker than gold now. Yeah. And we think that's caused by the stock market break recently. Well, we argue not. We think it's just the silver behaves like a wild dog. But look at the other variables out there that if they engage and you want a sense of certainty in your life, what do most people want to get into? Well, look at the portfolio action of like Newmont Mining. Stanley Druckenmiller back in mid-February probably laughed by other asset managers when it had bought a ton of Newmont Mining, and dumped a bunch of big name tech stocks. But it was a little early. The market didn't top out then. It was March, or February, March. Market didn't peak till last month. So he probably missed something on the tech stocks. But he bought Newmont Mining around $32. Right now on a dip, it's at 47. How come it's doing so well? If the stock market's starting to wobble, how come Newmont's hanging around its recent high, which is dramatically off its February, March low? It's a blue chip, the big blue chip. How come gold's hanging around quietly, 1% off its all-time high weekly close? Somebody's buying it. So, and I think part of the reason for that is not just foreign governments we know are buying gold, but I think there's a rise in domestic consumption of that too, where there's a sense of uncertainty, and asset managers here are looking for something that isn't going down. And if you start to break the stock market more and more of them will start to look for something that isn't going down. Doesn't have to be going up, just look steady. And T-bonds are one of those that we called recently. Sharp upside there, dropping yields on the long dated end of that market. And the monetary metals, I think, are hanging in tough, except silver's the wild dog, of course. But I think that as these events start to unfold, that's where money's going to go. And so it's hard to calculate what that political variable is. But it's got to be, I think it'll be net positive for gold and net negative for certain other assets.
Where can people find you if they're looking to continue to track this with you? I know it's olivermsa.com. Can you tell us a bit about that?
Yeah, our analysis, especially lately over the last year or so, has been more toward investment grade timing. So we didn't suggest you buy silver at $30. We suggested on the recent upsurge, if you weren't already long gold from much lower levels in silver, that when it came up through 25, annual momentum said, okay, if you're not in, you need to get in here. Not at 32 at the recent high. Okay. So yeah, it's well off that recent high, but it's still above that point of breakage, and gold is well above it. So we focus more not on short-term swing trades unless we think they're really significant and lasting. They're going to generate some long-term move. We're focused more on the long-term of the major markets right now, because I think right now what's going on is the resolution of an already ongoing monetary metal bull market. It is likely to be quite dramatic in terms of what happens to the upside in the acceleration phase of those markets, and opposite in some other markets. So if you're looking for something, not day trading type metrics, consider us.
Sounds good. We'll put a link in the description to that. Once again, just thank you so much, Michael Oliver, for joining us, and you have a good day and God bless.
Thank you, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for August 5th through August 12th, 2024, while supplies last. First, we feature 2024 1-ounce silver American Eagles at $5.50 over spot. Next, we have backdated 1-ounce silver Austrian Philharmonics at just $3.10 over spot. We also have Dealer's Choice Constitutional Silver half dollars at $2.50 over spot per ounce. Next, backdated 1-ounce gold American Buffalo are just $99 over spot. And finally, we have a limited quantity of 1-ounce silver full-color Trump Fight for America bars, just $6 over spot. They come 20 a sheet, and so have a minimum order of 20 and are sold in multiples of 20. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.